Forget everything you know about investing because what we're going to discuss today is a whole different ballgame. In 2024, there was an article produced by Financial Advisor magazine that highlighted how a quant hedge fund was cutting the tax bill of wealthy investors and the debate behind the rich getting richer and using advanced investment strategies to avoid paying taxes. So we're going to walk through what this strategy is, how it works, and how the ultra wealthy are using this strategy to avoid paying capital gains tax. If you're new to the channel, I'm Santiago. I've helped 9-figure clients manage and invest their portfolios, and I'm an investment analyst that helps others understand alternative investment strategies. The strategy we're going to look at in this video is called advanced direct indexing. So imagine if you buy an ETF, the S&P 500 ETF, SPY. There are only two results that can come about. The stock can go up and you can sell it for capital gain, or the stock can go down and you can sell it for a capital loss. But in direct indexing, what if we took this same exact concept, but instead of owning one share of the SPY ETF, we bought all 500 individual stocks of the S&P 500, essentially having the same holdings. But what if we had the ability that each month, the stocks that were down, we could sell off these stocks for a loss while maintaining a close tracking error to the S&P 500 to collect capital losses while simultaneously at the same time growing our account. This is the idea behind direct indexing. You can grow and follow the S&P 500 and continue to collect up to 30% in losses of the original investment. $1 million investment over the course of 8 years would collect around $300,000 of capital losses to offset other capital gains. Now, if we took that same exact concept of direct indexing, but on top of it, added layers of leverage to amplify our losses and offset more capital losses. These capital losses can offset a business sale, real estate sale, anything that's going to be taxed at capital gains. So according to a research paper written in 2023 by PMR, they found that the use of leverage at 250% long on top of your original investment and 150% leverage short on your original investment gained tax losses of up to 100% of the original investment. So if you put in $1 million in a span of 2 to 3 years, you would have $1 million of capital losses to offset capital gains. Well, if you can imagine, if you're saving on taxes, this increases your portfolio's performance return. And what the research found was that as the leverage increased, and if you open the bands of tracking error up, there was a clear outperformance of the usual benchmarks. So not only are you getting a tax efficient way to invest, but you are also getting tangible investment performance that adds to the added tax benefit. So how is this so powerful? Let's walk through a case study. Let's just say you have a real estate property that you invested in. You invested in this real estate property and you bought it for $1 million. And now this real estate property over the course of 20 years has appreciated to $10 million. And you are going to owe capital gains tax on this property on a $9 million capital gain tax bill. At 20%, this adds to $1.8 million that you would have to owe the IRS, and even more if you had state income tax in a high income tax state. Using this strategy, theoretically, you could offset that $1.8 million tax bill by investing $2 million in advanced direct indexing, letting that $2 million appreciate with the market and almost completely wipe out the entire tax bill while still growing your account. This is extremely, extremely powerful in the right hands and has caused a lot of controversy, of course, with Financial Advisor magazine. So the other side of the debate is, can Congress change the tax laws and prevent this from being used by investors? Well, to do this, they would have to fundamentally change the entire tax law around capital gains and capital losses. And let's just be honest, most of the individuals that are creating those laws are wealthy as well. I don't know who does or who doesn't use this strategy, but those individuals more than likely have capital gains too. And use capital losses to offset capital gains. So how do you feel about this strategy? Leave in the comments. Do you think this is controversial? Do you think this is fair? Is this strategy allowed because of an unfair advantage by rich and wealthy investors in the alternative investment space? I would love to hear your feedback. And if you are interested in reading the article by PMR, I will leave a link to this article so that you can do a little bit of research on your own. So now that we've discussed one of the most controversial investments over the last 10 years, go ahead and check out my other video to learn about why private equity is pouring billions of dollars into pro sports. And that video will be linked above.